Good evening, everyone. Welcome to our University of Florida Alumni Homebuyer Workshop. My name is Jason Maida. Great to be with all of you this evening. Thanks so much for taking time out of your busy schedules. I know on a Wednesday evening, a lot going on probably in your world, so I appreciate you dedicating some time to learn a little bit about homeownership tonight. So we have an action-packed class that's going to run just about an hour. This is a very interactive class. So as we go through tonight's content, we encourage you to ask questions of us. We're going to go through a lot of great information to share with you to give you some tips and resources around home buying, but we certainly encourage questions as we roll through tonight's content. You can ask questions by, of course, using the chat feature within Zoom or Q&A, whichever works easier for you. I'll answer those questions on air, and then at the end of tonight's class, we'll also spend some time just on any kind of follow-up questions that you might have. Really super excited to bring this content to you. It's a class that we put on for the Alumni Association 4 times a year, so it's offered every quarter. We have a lot of great participation in classes like this. And we're going to record tonight's class. So if you do need to kind of step away from your computer for whatever reason, you'll be able to kind of look back at the video tomorrow that'll be posted up on our YouTube channel. We'll also share back with you all of the slides from tonight. Okay. Now, my name again is Jason Maida, so I'm going to be your presenter this evening. I'm also going to be connected with you in terms of building your home buying plan for you in that pursuit of home ownership. And I work for an organization called American Pacific Mortgage, or APM. And we are the 9th largest lender in the country. We are a direct lender. Our team specifically focuses on home buyer education to help really prepare our clients in their community of pursuing home ownership. So we teach classes just like this to provide a lot of great value. And then whenever the time is right, we want to be here as a partner to help you kind of get to the finish line of achieving your goals of home ownership. Well, as I mentioned, as we got it launched in tonight's class, this is going to be a very interactive session. So we do have some talking points for tonight's discussion, but certainly encourage you guys to ask any questions that come up as we go through tonight's material. Here's kind of what we're going to talk about. We're going to look at the housing market and kind of what's happening today, specifically inventory levels, what some of the projections look like, but also take a look at interest rates. A lot happening with interest rates, as you can imagine, with what's kind of going on in the world today. We do want to go through an analysis of does this buying make sense for me? So I'm going to take you through one of our calculators that's available on our website. We call it a rent versus buying calculator that we walk our clients through just to kind of better understand what does it look like to make the transition from renting to home ownership, and does it really make sense for me? We'll also talk a little bit about credit, some tips and some tricks around credit to help you get in the best possible position when it comes to kind of really taking those next steps in home ownership. We'll also talk a little about loan programs that are available to you, including first-time buyer options that exist in your local community. And one of the challenges that a lot of our first-time buyers face is just saving up enough for home ownership, not really having enough in resources to get to the finish line. So we're going to talk a little bit about savings plan and those first-time buyer programs, as I mentioned earlier. And from there, I want to kind of walk you through the buying process. Where do we go after attending tonight's class? And I hope you guys have a few good takeaways from tonight's class that you can implement into your own home buying plan. But love to share with you is like, where do we go from here? So after you've attended tonight's class, hopefully it sparks some energy around home ownership. I'm going to walk you through where do we go from here? And that would include our consultative process to help you in your journey. And I'll obviously share with you how you can get connected with us after tonight's class. All right. Well, I'm excited to kind of explore this with you this evening, and let's kind of launch right into it. And the first thing we want to talk about is really, does buying make sense for me? Because for some of our clients that I work with across the country, it's not maybe the right time financially, or maybe there's some credit improvement opportunities. But I think when we consider home buying, it's really not the same to stack up your rent situation versus ownership, because when we think about home ownership, there's a lot of great benefits or attributes that come along with owning a home. For example, stability in my housing payment. So I don't have to worry about my landlord that's going to probably come to me and say, hey, Jason, time to renew your lease. We're going to increase it by 10%. Many of our clients that are buying in today's market, while we are at elevated interest rate levels, those clients, as they become homeowners, will have opportunities to refinance their home at some point in time. And that can actually improve your cash flow essentially, right? So if I refinance out of my 6.5 rate to say 5.5%, I'm going to improve my monthly payment amount. Now, this is an asset. And for most of us that are homeowners, this is our number one asset that we have. It has the opportunity to grow over time. So if I purchase my home at a certain price point, that home goes up in value. As I continue to pay down the principal balance on my mortgage, I create home equity for myself. And that is probably one of the number one asset for most homeowners, aside from maybe their retirement or their 401k accounts that they're contributing to on a monthly basis. And this really can be a transformative type of thing with homeownership, the ability to be able to create generational wealth for families. So tremendous opportunity with homeownership. And one of the pieces that a lot of people don't think about is tax benefits that come along with owning a home, potential tax deductibility of interest, as well as when I decide to make energy efficient upgrades to my home, for example, that could also improve my tax situation. So a lot of great things to consider with homeownership. And as we kind of get further into our discussion this evening, I thought I would share with you guys a rent versus buying calculator scenario because as I get a chance to meet with clients across the country, we're talking about those very benefits that I just reviewed with you. But I think it's important to kind of see it in real time. Like, what does this mean for me as a potential first-time home buyer? So I want to walk you through one of our calculators that's on our website. We're going to share back all of our presentation material with you tomorrow morning, but I thought I would kind of share this with you to kind of frame up a little bit of a reference point for you in our discussion this evening. So we do have several different calculators on our website. We're going to, again, look at the rent versus buying calculator, but we have other tools available like affordability, payment calculator. So a lot of great things that you can take a look at. Let's walk through kind of a real-time example of someone that's considering homeownership at the price level of, say, 400,000. And in considering that price level, the minimum down payment for a first-time buyer is 3% of the purchase price, or of course, $12,000. That would equate to financing $388,000. Okay, so we're going to plug that into our loan scenario, coupled with, say, market rates of maybe 6.5%, a 30-year fixed mortgage. We want to also project out when am I going to buy this house? And just for our what if, I just put in May, so a next month home purchase. We're going to talk about mortgage insurance a little bit later in tonight's class, but when you put less than 20% down, you are going to have mortgage insurance. And so there's a factor that's kind of put into your payment calculation based upon credit score, down payment, and then how much you finance. And then depending on where you want to buy in the country, there's going to be homeowners insurance, and homeowners insurance is going to be a little bit more expensive at different parts of the country. If we're buying in Florida, more in the coastal area, probably going to be a little bit more expensive as opposed to maybe a little bit more inland. Maybe we're going to purchase in one of the Midwest states, whatever that might look like. But we're going to have some type of premium that we're going to pay for homeowners insurance. We also have taxes. If you're looking to buy maybe a condominium or a townhouse, then we would want to think about HOA fees. And one of the things that gets lost a little bit, like I mentioned earlier, is just the tax benefits that come along with owning a home. So what tax bracket am I at? And when I'm a homeowner, how much cost am I going to have in my home? So that's plugged in there. Eventually, I'll probably sell my home. So maybe it's in the 6 years, how much am I going to have to pay to maybe connect with a realtor to sell my home? Appreciation, this is one of the big components, right? So our home hopefully will be on a trajectory of increased value over time. Different parts of the country appreciate at different rates, but let's just use a nominal number of, say, 3%. And then we're going to stack that against a rent scenario. So this assumes someone's paying, say, $3,000 a month in rent. We could even lower that to $2,000, but we'll use $3,000 for this exercise. Renter's insurance costs. And then we're also going to assume that this client's rent goes up by about 3% every year. Okay, so probably not out of the realm of possibility there. Now, I think we could probably make the argument that we could adjust the rent down a little bit, but I would encourage you guys to walk through this exercise yourself once you get some of these tools tomorrow. But what this calculator does is it, first of all, tells us what's the break-even point. So with my investments in terms of down payment and closing costs, how long is it going to take for me to break even on those expenses to make homeownership worth my while, right? And in this scenario, it's going to be 2 years. So that means once I hit the 2-year mark, I break even. Everything beyond that is going to be all on the plus side. And after that 2 years, it gets kind of exciting for us financially because, hey, let's span out to 7 years. 7 years, if I'm going to own a house versus renting, I have about $144,000 opportunity of owning a home versus renting. And obviously, the further I retain that asset, the better I'm going to see an improvement of that asset. Now, let's face it, housing markets do cycle. Depending on what part of the country you're in today, there might be more inventory than others. So that inventory level can also influence ultimately kind of what the desired price is of your home. But I think as we consider entry point to home ownership, this is a great calculator that puts in some of the ingredients that really make up the true benefits of home ownership. So I would encourage you to check that out when you have some time. And certainly as part of our consultative process that we offer to our communities that we serve in home ownership, I'm going to have a one-on-one with you to kind of walk through that together. But a lot of our clients really find that to be a really super useful tool. So we're going to kind of pivot from just talking about like what ifs and the benefits of homeownership to talk about like what's in the housing market today. So let's spotlight the Florida housing market for right now. And I know our alumni base spans the entire country. So you may be looking in Georgia or Texas or California, but I think it's important to have some perspective on what the housing market looks like right now. Today we're in like the spring, summer buy or spring, and then we'll transition to summer buying season. Generally, we see like activity levels pick up at this time of the year. We see a lot more buyers engaged and looking at what's happening in the market, even aside from what's happening kind of globally with the crisis in the Middle East right now. That is still not really hurting the housing markets today. We're still seeing a lot of buyer activities out there. Generally, in the spring and summer buying months, we also see more sellers engaging. So meaning they're putting more homes on the market at this time of the year. In Florida specifically, this is one of four states that has the highest level of inventory today. So Florida, Georgia, Texas, and Colorado have the highest level of inventory today. So it truly is a buyer's market today in Florida. So you can really negotiate, I think, favorable terms for you as a buyer. You can see right now in the state, we have 77 days, median days on market. You can see the trend in terms of uptick in inventory, which we're up 7.2% year over year. Median sales price is also up a little bit, but not huge. And so, you're seeing this kind of a trend here. I think if we were to kind of push this out a little bit further, my guess is we're probably going to be a little bit more flatter here to possibly decrease in the state. A lot of things that are kind of like putting a bit of a damper in the housing market in Florida specifically would be the cost of insurance. Insurance has gone up considerably. And we also see that in states like California. Fire insurance is through the roof here in California as well too. So, I think when we consider home ownership in Florida, for example, I think there is really some opportunities as buyers if we're financially ready to go and enter the market. Now, nationally, what does the forecast look like for this year? Well, this year's set to be a little bit of a kind of a reset in the housing market. Might see a little bit better affordability because we did project interest rates to decline this year. We'll talk about interest rates in just a bit, but with the conflict in the Middle East, that's kind of put a little bit of a pause on those projections that we had for this year. Price growth is expected to be a bit modest. We won't see really any big jumps in most communities in terms of values. Some might even see small dips, especially oversupplied markets. We could see a little bit of a dip in price. Inventory will improve in all markets across the country is what we're kind of projecting. So we might see sellers now kind of re-engaging a little bit more. Over the last years post-pandemic where, clients that, or existing homeowners, I should say, that refinanced into 2.5% and 3% rate loans really couldn't afford to make that upgrade in home or make the move to a different community because they were trading off such a low interest rate for a rate that's maybe 2 times what they're paying for, maybe 3 times what they're paying for an interest rate. But I do see, even with our own client database, we're starting to see clients that are saying, I really want to get my kid into that school district, or I really want to move to that part of a community. And so now they're kind of being willing to make those trade-offs. And so you're starting to see also that influence supply numbers in a positive way across the market. And I do think as we look at home ownership for 2026, those that are ready feel like they're positioned financially. I think there is some opportunities to be taken in local markets as an entry point to home ownership. Now, when we stack side by side 2026 projections versus 2025 actuals, you can see, mortgage rates, our projection was to go here. We're not here for Q4. Got a little bit of improvement to do. We'll see kind of how the market plays out. We look at existing home sales will go up year over year. So that's encouraging for us. We're seeing prices just about the same. That's not a big movement in median home price. And then inventory levels, as I mentioned, seeing a decent increase to really support our buyers all across the country. So that's encouraging news. What we're trying to navigate through right now is the level of interest rate volatility that we see in the market for our existing clients that are actively shopping for homes or maybe currently under contract with a seller. Here's a snapshot of the last 12 months of interest rates. And then you can see down here in this graph here represents rate history over the course of the last, 30 plus years, or 50 plus years, I should say. So I want to kind of first look at what's going on today in the market. So you can see this like big move up in interest rates. relative to where we were going. We were pretty excited right around here, and that was about February 27th. Rates were trending lower. You could see probably social media posts that where everybody was talking about the sub 6% interest rate, which would open, a lot of opportunities for existing homeowners, but better affordability for buyers. But then over the weekend, we had the conflict in the Middle East arise. And so now that trend has changed quite a bit. So we saw interest rates push up to levels of right around 6.5 to 6.6. We did touch down close to 6.75, which is not reflected on this graph. We have come down with some possible signs that the conflict might be cooling a little bit. So interest rates are kind of reacting a bit better. So we're seeing rates around that 6.4% level, depending on the day. This will continue to be a very volatile interest rate market until we get things figured out. And so obviously we're watching that really carefully for our clients. Now, beyond that, if that didn't exist, the two metrics that we're looking at in the U.S. economy is inflation, which the mandate by the Federal Reserve is 2% inflation. And then what's the health of the employment numbers look like, or the labor markets. And so if we didn't have what's going on globally right now, we would just be kind of zeroed in on those things. But obviously what's happening is kind of the cloud that's hanging over the market. So hopefully we can get resolution on that front. And then obviously, depending on what the market does here domestically, that will move interest rates. I do think we'll eventually start to see interest rates start to settle down and maybe get back on track to where we were going pre-conflict. And this is a look back at, like I said, the 50 plus years of interest rates. I always like to kind of share this too with our classes that I teach, that to remind everyone that really the rate levels that we saw during the pandemic was an anomaly. It was the lowest historical rates we've ever seen. We will more than likely will never return to that. Hopefully we don't, because then something really severe has happened globally. The average or historical average in interest rates is usually in the high fours to low fives. That's generally what we see. Now, when we think about interest rates in home ownership, there's different elements that go into what an interest rate is. That includes credit score and eligibility for a product, the type of program you're going to do, how much you're going to finance, what your down payment looks like. And you do have the option as a buyer to pay what we call as discount points, where you're essentially paying more expenses out of pocket in order to bring down that interest rate. So if your market rate with no points is 6.5%, but you really want to get to a 6.25% rate, that might cost you, say, 1% of your loan amount. And then term of my loan can also influence where I go with interest rates. So generally, the shorter my term is of my loan, so traditionally we do a 30-year fixed mortgage, but if I condense that down to, say, a 15-year fixed mortgage, that can also help improve my interest rate offering. Now, you've heard me talk a little bit about consultations in our presentation this evening, and that's what I do one-on-one with clients when we build their home buying plans. And we'll talk about different scenarios for you, because obviously things like purchase price and down payment and monthly payment are really important. But it's a question of, like, how do we get there? And as we meet for that consultation, we're going to figure out what that plan might look like for you. Probably the biggest influencer of interest rate, product selection, and then mortgage insurance is credit scores. So when we have a consultation with you, we're going to figure out, how do we optimize your credit score given where you're at? And every loan product does have a minimum credit score. And you can see some of those loan programs spotlighted on this slide here. Now, there are 3 different agencies that report out a credit score, and you guys are all familiar with those: Equifax, Experian, and TransUnion. They also report out different scores to us based upon a risk model. Now, in lending, we always take the middle credit score of all 3 bureaus. So if my highest score is 760, let's say my lowest or my middle score is 740 and my lowest score is 720, well, 740 is my middle score that is going to be used from a lending perspective, which again will influence interest rate. It'll influence my product selection and mortgage insurance. If I have my partner that's also going to apply with me, but my partner's middle score is, let's say, a 720, well, that 720 is slightly lower than my middle score of 740. So if we apply together, we could see a potentially lower interest rate, or maybe overall kind of a little bit more expensive financing because that person's score is slightly lower. Now, there are 3 different models to credit scoring. There's the credit card model, there's auto financing, and then there's the mortgage model. So of course, when you're applying for home financing, we're using the mortgage model. We're going to look more specifically at the mortgage model this evening. We're going to look at some of the weightings that go into a score, because I would encourage our class to, as we go through that, kind of review, maybe identify some potential areas of opportunity for you in your own credit score. Now, if you've had some past challenges in credit, let's say a late payment or something like that, it's going to impact you in the most recent 12 to 24 months from the date of the event. As you get further away from that event of happening, let's say I had a late payment on a credit card in October of 24. Well, once I reach the 2-year mark, I'm probably going to see some improvement in my credit score. It will, as the image of your late payment will stay there for 7 years, but the further I get past that, the more improved I'll see in my credit score. So, and I thought I would pass along this little matrix for you. So if you've had some past challenges, just to get a better understanding of how long they'll stay with you on your credit report. Well, here's what the mortgage model looks like for credit scoring. So I kind of take you through the weighting that we see in the area of importance in the mortgage score. So we're going to start kind of at the top here, which is essentially length of credit. So the longer I've had my credit, probably the better my credit score is going to be. If I was, let's say, comparing someone that has 6 months of credit history versus 6 years of history, all things being equal, the 6-year history is going to be a little bit higher of a credit score because it's much more established. Now, as I'm trying to establish credit, then we get to the in use, right? So how much new credit am I trying to get access to? So we really want to avoid opening significant amount of accounts, especially in a short period of time, and having those creditors do hard inquiries on your credit, because hard inquiries can lower your credit score. Now, one of our unique things that we do in our process with our clients is we always start with a soft credit check. And the reason why we choose to do that is because I want to help educate our buyers and provide a plan for homeownership without impacting their credit score. And so a soft credit score allows us to do that and have them start their home shopping. Now, once they go under contract with the seller, then we initiate that hard credit score inquiry, but it doesn't have to be done at pre-approval. So you really want to minimize the hard inquiries that you do just in general. Next component, which is probably the biggest area of opportunity for most of us in class, which is just how we're managing revolving debt. So that is credit utilization, comparing our credit limits versus our credit balances. So ideally, we want to have those credit balances at 10% or less of my limits. If I've run a little bit higher on my balances because of a big purchase that I just made, we want to make a big effort to try to get that utilization as low as possible. For example, if I have $10,000 in limits and I'm currently at $8,000 of balances, I'm right now at 80% utilization. My first action item for our client would be, let's try to whittle that down to 50% utilization. Okay, that'll see a little bit of an uptick in our score. Next step would be, let's get to 30% utilization, and then ultimately let's push that down below 10% utilization. So when I meet with clients throughout the country, that's probably where we kind of zero in when we look at someone that has, say, a 710 credit score and we're trying to get them to a 760 score. That's generally where the area of opportunity exists. Now, how do we manage that credit card debt effectively? Well, the credit bureaus take a snapshot of what's happening with your accounts, for example, at the end of your billing statement date. So when the billing statement closes, the credit card issuer is going to send out that information to the 3 agencies: credit limit, credit balance, pay history, all that stuff. What my recommendation for class would be is if you can try to pay down those balances or pay them off ideally, by the end of the billing statement date, you're going to get a much lower balance that reports out to the agencies, therefore lowering your utilization and lifting that credit score. So great way of kind of managing your credit card debt. And then the final component is just pay history. So how have I paid my bills? If I've had any reported late payments, they're going to be rated as 30-day lates, 60-day lates, and then 90-plus day delinquencies. So the more severe on that spectrum of lates I am, probably the bigger impact I'm going to have to my score. Keep in mind, though, we're looking at the 12 to 24 months from that event date. So going back to my example of the credit card late payment of 24, like once I hit past October of this year, I'm probably going to see some impact or improvement, I should say, in my credit score. Now, continuing on the theme of credit, let's talk specifically about accounts that some of us in class might have that we have to deal with, which is just student loan debts. And I know a lot of our clients that I work with across the country are having student loan payments that are coming online. So we're seeing that more frequently in today's market. Some of you might still have student loans that are in litigation right now and not making any payments. In fact, I was just talking to one of our clients earlier this morning with that scenario. However, when you apply for mortgage financing, if you're not in repayment today, let's say you have $50,000 in student loan debt, but you're in forbearance right now, I still have to count a minimum payment for qualifying when it comes to a mortgage. So if you're going to apply for an FHA loan, let's say you have $75,000 worth of debt, then we have to assess a 375 monthly payment to qualify you in looking at your expenses versus your income. If you're looking at, let's say, a conventional loan and you have that same amount of student loan debt, then we would have to take $750 as the assessed payment. So that's kind of how we would look at it from the lending perspective. But if you're in a current active payment plan that you're making payments on for that same $75,000 in debt and it's $250 per month, well, that's what we can use for qualifying for your home financing. So every case is a little bit different. I think the thing I would encourage our class to think about is if you're not in repayment right now, whether that's deferment or forbearance, we are still going to have to count a minimum payment for qualifying. And I'll take you through that as part of your consultation to make sure that we understand where the student loans are at, but are they impacting us in terms of our buying power for home ownership? The reason why we look at student loans is because every loan program that we support our clients with has guidelines around student loans and other accounts for that matter. I want to give you kind of a high level look at some of those loan programs that you might have heard about or have already done some research on. The first one is a conventional loan that's offered through Fannie Mae and Freddie Mac. For first-time buyers, you have a minimum down payment of 3%. That 3% minimum goes all the way up to what we call the conforming loan limit, which today is $832,750. Now, if I'm going to buy a place in Santa Clara County in California, well, that's called a high cost of living area. So you can go beyond that maximum loan amount with a conventional loan, but it also does elevate your minimum down payment from 3% to 5%. Okay, so most of our clients are going to be buying within that conforming loan limit, which is the 3% minimum down. And then that also does have a minimum credit score requirement on the conventional product. FHA is a Federal Housing Administration loan. That is a government insured loan. 3.5% is the minimum down payment for an FHA loan with a minimum credit score of 580. Now, the loan amount's a little bit different there on the FHA space. That does change by the county that you're going to buy in. So depending on where you're going to buy in the country, that will influence what that loan amount does. Now, both the FHA loan and the loan below that, the USDA product, are both what we call government insured loans. So unfortunately, there were some changes made last year that impacted who's eligible for these programs. So you do have to be a permanent resident to access either one of these government insured products. Doesn't make a difference with the conventional loans. So those are agency products offered through Fannie and Freddie. You can be a DACA recipient or just a non-permanent resident and still get access here, but you do have to be, unfortunately, a permanent resident for these government insured products. With the USDA product, it is a design to support buyers that need to purchase in more rural areas. The benefit around that is you get 100% financing. And there are two elements to a guarantee fee that's charged to USDA. There's a 1% guarantee fee, and then there's a 0.35% monthly guarantee fee. So that's all factored into USDA. But really the benefit is zero down payment as an option. You do have to be in qualified areas and not exceed an income threshold. Okay. Jumbo loans aren't really going to be in the space of first-time buyers. We certainly offer it, but it does have elevated down payment requirements and asset requirements. One of the products I don't have on screen, but I always like to share it with our audience, is that we do also offer a physician's loan. And why that's important is because a physician's loan can allow you to have a minimum down payment, like let's say 3%, 5%. But where the benefit comes to the physician's loan for those that are eligible is that we don't look at student loans in the debt to income ratio calculation. So you're going to learn about debt to income ratio tonight, which is expenses versus income. But on a physician's loan, we do not count that in. So if that's something you're interested in, feel free to reach out to me or we can talk about that in class a little bit later. Last product is the VA home loan. That's for our veterans that have eligibility as a veteran recipient. Zero down payment is the option or the minimum down payment. So there really is no requirement for down payment. A lot more flexible underwriting guidelines for the veteran. No real maximum loan amount. So that is a great opportunity for our veterans. There's also a little bit more of a kind of relaxed approach when it comes to expenses versus income. So not as a stringent debt to income ratio requirements. All right, we're going to talk now about private mortgage insurance, and we're also going to talk about mortgage insurance premiums. So they both function the same, but they have little nuanced differences. PMI stands for private mortgage insurance, and private mortgage insurance comes into play when I put less than 20% down to purchase a home. And as I mentioned earlier in our rent versus buying calculator, The characteristics that go into PMI is down payment, credit score, and amount financed. So that determines what my premium is going to be. Now, with mortgage insurance on a conventional loan and with MIP for that matter, that mortgage insurance is protections for the lender. So if something was to happen, economic hardship, I was unable to pay my mortgage, then that insurance would protect the lender against that default. Now, one of the benefits with PMI on a conventional loan is it does have a cancellation option. So once I achieve a minimum of 2 years of my loan and I have 20 to 22% equity, I can apply to have the mortgage insurance canceled. Unfortunately, on the FHA side, which is MIP, that's not an option. So the only way really for me to exit FHA mortgage insurance is if I was to refinance out of that FHA loan into more of a conventional product. Now, with FHA mortgage insurance, there's two elements to it. There's monthly mortgage insurance, which is 0.55% of my monthly amount. And then there's upfront mortgage insurance, which is 1.75% of the total amount. And that gets financed into your total loan balance. Let's look a little bit closer about the real cost at each side of these products. So on a conventional PMI scenario, let's say I financed $450,000, putting 3% down on my home purchase. That PMI amount's probably about $138 a month, assuming a 740 credit score. So not bad. On the FHA side, it looks a little bit different because then I have upfront mortgage insurance, which is going to add $78.75 to my loan balance, plus that monthly amount that I'm going to be paying on the mortgage insurance. So, two different products, but I would say as you evaluate options, and of course, we'll help you through this, FHA is going to have a lot more flexibility and eligibility for our clients, meaning from a credit score perspective, maybe expense ratios, time on the job, income, a little bit more flexibility in FHA as opposed to conventional. And so we're going to evaluate which options make the most sense for you as we kind of evaluate scenarios. The last thing I want to touch on with PMI, because I actually had this conversation with the client earlier today, is they were running calculations on Redfin and Zillow and thinking that mortgage insurance was significantly higher than what we went through in our calculations together. And so we have some really helpful calculators on our website, which I shared with you earlier. Encourage you to check that out. I'll obviously help you through that too during a consultation. But when we look at these numbers here of $138 a month, it might be $200 or $300 a month, maybe even higher on some of the search sites that you might be accessing. All right. We're going to now transition into qualifying income for home ownership. I get a lot of questions around employment scenarios of like, does this income work for qualifying? What can I do here to access home ownership given my employment scenario? So before we dive into some scenarios, I wanted to pass along some of the documents that we'll generally ask for in the process. So as you're ready to take the next steps in home ownership, I thought I would pass along some of the expected documents that you can upload to your profile. So pretty easy stuff. Taxes are generally not needed unless you're self-employed. But usually it's just the last couple of years of W-2s or school transcripts if you're just new to the workforce, bank statements, and then your most recent 30 to 60 days of pay stubs. So that's kind of the general documentation requirements. But let's talk about some employment scenarios because I get a lot of questions around this. I was working through a couple of scenarios earlier today. In lending, we do require that you've been in the employment or labor markets or in working on your education for the last 2 years to qualify for a mortgage. So for example, if I graduated from UF in let's say end of 2025, right? Finished up last year, but I just started my job January 1, I can still be eligible for financing because I can show that I've been working on my education, which obviously connects to my career path now. So that could satisfy the 2-year requirement. So you don't necessarily have to be on the job 2 years in order to be eligible for financing. We just have to show that 2-year work and or educational history. Okay, so that's really important. Now, if I'm in a role that I have base salary plus commissions or bonuses or overtime, variable sources like that, now that's a little bit different because I do have to show that I've been on the job 2 years in order to count both of those, or not both, but to count my base salary, for example, and some of those variable sources. So because we want to see kind of what the historical averages look like for you with those variable sources of income. Now, if you're self-employed, we do have to show that you've been a self-employed individual filing 2 years of taxes simultaneously for 2 years. So if I just open my business in, let's say 2023, then I should have 2023's filings, 24, and probably just getting ready or have already filed my 25 tax returns. Now, if I have dual employment, So let's say I work for multiple employers and I want to count both sources of income. Let's say I'm a dental hygienist and I work for two different practices. If I want to count both practices, then I have to show that I've been demonstrating that work for 2 years simultaneously in order to count both sources of income. Okay. And then another scenario we get often is where someone's working a 40-hour work week job, but let's say they have some extra time on the weekends and they drive for Uber or Lyft. We can certainly look to introduce that income. That income is usually Schedule C income because you're getting paid a 1099. But to count both sources of income, we have to show we've been on both jobs simultaneously for 2 years. And then last thing I would just share with our class is that, we also get situations where clients are looking to add additional income that they receive, but let's say a partner is contributing to the household. So they are giving, let's say, $1,000 a month towards rent, but they're not going to be on the application. If they're not going to be on the application, then generally we won't be able to count that income towards qualifying. All right, now we're going to take that income approach and we're going to kind of overlay it with expenses. So when we think about qualifying for financing, we do a calculation in lending called debt to income ratio, which is looking at your pre-tax income versus your existing expenses plus your new housing expense. So my existing expenses would be things like a student loan payment, car loan, credit card, personal loan, things like that, plus that mortgage payment that I'm making. So the mortgage payment would include the principal and interest of my loan, property taxes, homeowners insurance. Maybe I'm putting less than 20% down. I'm paying mortgage insurance. So that all gets kind of factored into this line here, right? And then I take my other debts of $500 a month, and then those get divided by my pre-tax income. So in the scenario that we have on screen, we have someone that's paying $3,000 in projected expenses with their new housing payment. They're making $8,500 a month. So right now their debt to income ratio is 35.3%. Now, in lending, we don't want that percentage to be more than 45, even as high as 50%. That's getting kind of tipping the scales a little bit. The question I get often from buyers is, where do you think I should have my debt to income ratio? My general rule of thumb is like 33 to 36% is kind of the sweet spot, if you will, for most first-time buyers to create kind of the best affordability. But everybody has a different threshold of where they want their expenses to be. Some people feel better at 25% debt to income ratio. Some are like, hey, I feel good at 42 because I have all these other income I'm making on the side, but I just can't document it. So I do think everybody's situation's a little bit different, but we're going to help kind of guide you through that. It's really important for us to be able to kind of hit the target when it comes to affordability because as you're making this major purchase, which just obviously is going to be the biggest financial decision you've taken on, we want to make sure that we don't miss the mark there. Affordability is paramount when we design these options for our clients. The last element to understanding homeownership before we get to the workflow is how do I get to my down payment and targets of homeownership? We've heard a little bit about the minimum down payments. So I want to share with you what are resources that qualify as a down payment asset, but also let's work on saving towards homeownership. So here's some of the documents that are acceptable to use to verify assets. Obviously checking and savings accounts are allowed. We just can't use cash deposits. And I always like to share that in class because we have to have assets seasoned at least 60 days in homeownership. So if you just got a $10,000 cash deposit going to your account, unless it's been in there for the last 60 days, we're not going to be able to use that to count in towards the calculations. Okay. But you can also use retirement accounts, 401ks, 403bs, and brokerage accounts. I just always encourage clients, talk to your financial or your tax advisor before you dip into those assets. We want to make sure that's a good move for you to liquidate those type of accounts and put those into home ownership. And then gift funds can also be used. That's where a family member is basically saying, hey, Jason, here's $10,000 in gift funds that I want to contribute towards your purchase. Has to be an immediate family member, but in that case, there is no seasoning requirements. There's just a documentation process we have to walk through. Now, as we prepare you for home ownership, savings is probably the biggest challenge for most clients. And we're going to talk about first-time buyer programs in just a few minutes. But one of the approaches that we've found to be pretty successful with our clients is a savings plan. And it's something that we work on as part of your consultation. But we take a look at what you're paying today from a rent perspective, what we think you can pay or what you think you can pay from a mortgage perspective, and we start saving with that variance. And so what I mean by that is if you're paying $1,500 a month in rent today, And at the end of our discussion during a consultation, you're like, hey, I think I can afford $3,000 based upon what I'm taking home every 2 weeks, whatever the case may be. I just need to save more. So how do I do that? So I would encourage our client is at the first of the month when I pay that $1,500 a rent payment, now let's create that discipline for ourselves that we're taking an additional $1,500 and we're transferring it right to our savings account. So we're kind of like acting like we're paying that $3,000 mortgage payment on a monthly basis. By instituting that type of discipline, what I do is obviously I save myself $1,500 a month because that money gets routed right to my savings account. And of course, I'm paying my rent. That money starts accumulating month over month over month. End of 6 months, I have $9,000 built up. By the end of the year, I have $18,000. And I was just talking to a client yesterday to implement a plan like this. Let's also look at putting that into a high yield savings account to get 2 or 3% interest, whatever the going rate is. So I think that's a really simple way of doing it. I know that the math is not really complex, but I think it's just the multiplier of creating and the discipline of getting that money transferred to that savings account. It is truly a discipline, but I think that can really help you reach the path to home ownership. And that's one of the things that we have seen several of our clients do to really achieve that level of success. Now, first-time buyer programs can also help you get there. In the state of Florida, we do have different programs that we can implement as well if you're eligible, but there are income limits to most first-time buyer programs. And at some cases there will be asset limitations. But in Florida, we have the Florida Assist program, which is up to $10,000 in assistance. And then there's the HLP program with additional up to $10,000 in assistance, but it's forgivable after 15 years. So that's a great way of getting some support. There is another program that's 3 to 4 and 5% in forgivable assistance through the HFA program. Most states, if you're not specifically looking at Florida, have some type of low to moderate income first-time home buyer agency encouraged to create affordable home ownership in that respective state. If you're not looking to purchase in Florida, let's talk offline or certainly drop a question in the chat and we can talk through different programs that are out there. But every state has some type of resource out there. It's just about plugging into the right one that makes sense for you. To continue on with Florida, there's also the Hometown Heroes discount program as well. So for first responders, educators, childcare employees, and active military or veterans, you can also get some additional incentives. So a lot of great tools in the state, but there's also similar tools, like I said, across the country. Nationally, within APM, we also offer the Pathway DPA program. Now, the benefit here with Pathway, there's no income limits, and you can also get 3.5% to 5% in assistance funds. In fact, we've helped some of your fellow alum here in Gainesville with the Pathway program. A great tool to help our clients out. We also offer for clients that make less than 80% of the median income, our 1% program, which essentially means you put down 1% of your own money, APM will grant you another 2% to make up that 3% minimum down payment. So another great tool to help you in achieving home ownership. All right, well, our next stop in our discussion tonight, which is our last topic, and probably the most important one, is the workflow of buying a house. Where do I go from here? That's probably one of our top questions we get from most first-time buyers beyond probably what are interest rates. So I wanted to take our class through the workflow of buying a house in our 6 steps of home buying. And this is something that, is kind of really what happens after class. So after attending tonight's class, like you've heard me mention a couple times, which is I'd love to be able to connect with you for a consultation. That's a 30-minute virtual session that I do with all of our clients across the country to kind of really build your home buying plan, strategy, and objectives for home ownership. That's a very interactive session we do virtually. And then what comes out of that session is to possibly get pre-approved if that's the position you're in, or maybe just build a plan. So we're going to revisit this in six months or a year, whatever the case may be. But assuming we continue with the pre-approval, that pre-approval is good for 60 days, but it can be recertified at any time. And I always encourage clients that shouldn't feel rushed to go out and buy a house just because you get pre-approved. It's just giving you a baseline of eligibility. Now, we can tailor that pre-approval to any property that you find some interest in. But step 1 would be conclusion of that consultation and pre-approval. Now, it's really up to us if we're going to move to step 2, which is the house hunting phase. And that's where, maybe you're just searching online, but you're probably going to connect with a local realtor to learn a little bit more about your options, communities, walkability, school district, whatever is really important for you on your checklist of items. Maybe it's the pool that you want in a house, whatever the case may be. We have preferred realtors that we work with across the country. So if you do want us to introduce you to someone after your consultation, we're more than happy to make that connection. I always get asked often is, Jason, what's the longest stage in the process, right? I would say that one is house hunting, because the right house may not have popped on the market right for you or that particular community that you're looking at. But I think it's important to be pre-approved and ready to act, because things move really fast in the real estate market. Now, let's assume that you find the home that you love and you want to make an offer on a house. Well, that realtor is going to help construct that offer, including the timelines of the transaction. They'll generally partner with me on what that looks like. But if that offer gets presented and accepted by a seller, and by the way, as a side note, it doesn't always happen on the first try. So we got to make sure that we have realistic expectations. So it could take 2, 3, maybe 4 tries to get the right house. But let's say that offer does get accepted. Well, then you're going to move to step 3, which is called entering escrow in most parts of the country. Essentially, what it means is you have a ratified contract now with you and a seller. Okay. The day we get advised of that as your lender, I'm going to give you a call and say, hey, congratulations. You got your offer accepted. Let's walk through some next steps. Let's share with you a little bit more about what our team's going to do to support you on this journey and get you scheduled for your follow-up video session. And that follow-up video session we do with all of our clients is a 45-minute session where we go in, we talk more specifically about, okay, let's look at interest rates today now that you have an accepted offer. Let's look at the timelines of the contract. Let's look at your payment, your out-of-pocket expense. Let's talk about insurance and what you need to be doing on that front as well. So that's a very comprehensive thing that we do within about 48 hours of the accepted offer. Now, you'll have other things that you'll need to do as well as a buyer, like making your earnest money deposit for your house. And in every community across the country, you are going to have to put some type of good faith deposit in. The dollar amount might look a little bit different, but the general rule of thumb is 1 to 2% of the sales price. That deposit counts towards your total out of pocket and essentially is like a good faith deposit that shows the seller that you have financial stake in the success of the transaction. Now, in most parts of the country, there's also contingency periods inside that contract, which protect you as the buyer, which state that, maybe you're going to get the house inspected in a certain amount of time, and you want to make sure you see those inspections before you go all in the transaction. Also, appraisal contingency to make sure the house is worth what you're buying it for, and your loan approval to make sure you can have your loan financing approved. There should be no surprises in loan financing at that point, but we just want to make sure that everything is solidified so you're not at risk of losing that deposit if for something didn't come to fruition with the financing or just the in general transaction. As we continue to move down through this workflow, step 4 is going to be kind of more of the administrative stuff we'll be doing as the APM team behind the scenes, verifying employment, verifying your assets, getting disclosures delivered to you. We have this bullet point here about rate locks. We are going to be talking a lot about rate locks because rates change every minute throughout the trading day. From 6 a.m. to 2 p.m. during the day, rates can change really based on what's happening in the news. You guys heard me talk a little bit about rates earlier. So we want to be very strategic, and I consider that one of our value adds to our clients. We're really watching intently on what the markets are doing. So step 4 concludes with us submitting now to the underwriting team. We have an underwriter who now officially approves your loan. And then at step 5, we have that approval. That also gets us to the end of our contingency period. So we probably got our inspection back, our appraisal checks out okay, and we have the loan approval. So now we're ready to remove that contingency. But we want to be mindful that that contingency removal also tells the seller that, hey, we're all in. We're ready to go. We're ready to close the transaction. And throughout these milestones that I've just shared with you, you're going to be getting disclosures sent to you. There's initial disclosures within 72 hours of our contract period. There's also redisclosures that come out once your interest rate is locked. And then finally, you're going to get a 3-day cooling off disclosure called a closing disclosure at step 5. So that gives you a cooling off period as a buyer to just make sure, hey, everything aligns with what I've been seeing throughout the process. So there's no variances to that. Now that'll take us to step 6, which is the very final milestone. That's called closing the loan. So in a state like Florida, we call that a table funding state. So we're going to sign our loan documents the same day that we fund the loan and you contribute your funds. So that would close on that same day. So that's the date I take possession of the home. So that basically means I've signed the loan documents, transferred my funds, received my lender's funds directly to the title company, and then documents record with the local county recorder's office. They'll record a grant deed to transfer ownership and then a deed for the loan that says, hey, I'm going to pay back my loan, right? Once we get confirmation that those things have been recorded, guess what? Now you're the new homeowner, and it's truly a day of celebration. I get a chance to call and celebrate that and congratulate our clients at least once or twice a day. It's probably the best part of my day next to teaching classes because it is a true accomplishment, a big financial milestone for our clients. And we want to be there to celebrate you and what you've achieved. Our relationship, though, with our clients doesn't end there. Part of our aftercare that we do with our clients is staying continually connected with them, whether there's a rate refinance opportunity that presents itself through our Rate Watch program, providing you tools like our HomeBot system to track your home equity and see how you can pay off your mortgage quicker, or just checking with you on an annual basis to see what's happening financially and see how the house is doing and see if you have any plans for home improvement. Whatever the case may be, we always want to be here as a resource for you. We don't look at this as just a transaction for our clients. This is a long-time relationship with our clients over years. And I'm proud to say that we've had thousands of clients that we've helped out throughout the years that really it's truly a relationship that we get to chance to see our clients grow over time. Now, as you're thinking about maybe taking the next steps in homeownership, I'd love to be able to get connected with you for a consultation. Again, that's a 30-minute virtual session that we do with all of our clients. It starts with a couple action items on your side, like getting your online application completed. You'll upload some documents, and then you use our scheduling system, as you can see right here, to schedule your virtual session. We can certainly do it over by phone, but we love to screen share, just like we're doing in tonight's presentation, just some of the budgeting tools and just some of the really key elements that we want to talk through in homeownership. That is a free service we provide to you. And again, reminder, that's only a soft credit check that we do in that consultation. Here's what that consultation might look like for you. A lot of the key topics mirror what you've heard this evening, things like doing some budget planning, talking about affordability, where do we want to buy, get a better understanding of interest rates. Maybe there's some credit opportunities for you. All those things we're going to kind of capture within that consultation session. As we kind of conclude tonight's session, there's also other tools offered to you, like our mobile technology. You can start the application process right there. We very much embrace technology in our support of our clients, but it doesn't replace the human side of our business because it is a very high-touch process that we create for our clients, whether that's simply just calling us up and saying, hey, got a question about this, or dropping us a quick text. We always want to make sure that we're always connected to our clients. Part of our community benefits obviously includes classes like this that you're attending tonight, but we also offer a discount in our services that we provide to our community. So there's a $750 discount as you choose us as your provider for either purchasing a home or refinancing. But of course, you always have access to our free classes that are available to you as well. If you've enjoyed tonight's information, love for you to share that back with your friends, family, maybe some of your coworkers. We will teach and have over 10,000 people sign up for homeownership classes this year. So obviously, it's something that everybody's on the minds of many. And if you do have someone within your network that would enjoy this class, please feel free to pass along this information to them. Again, we've recorded tonight's class, so it'll be up on our YouTube channel, so you can kind of take a look back at some of our key concepts for tonight. But we certainly want to make sure you have all the resources you need, including we'll get that slideshow out to you tomorrow as well. Last thing I just want to point out is, as we're considering homeownership, I think it's important for you to see the experience of others within your own U of F alumni network. We've had several clients that I've helped that have attended classes just like this, that have shared some of their testimonials in their experience with us in the journey towards homeownership, to go from classroom setting to actually getting the keys to their house. And so we're really proud of what our community says about that, says about us. So I'd encourage you to check out kind of what those comments look like in some of our social platforms like Instagram, some of our Reddit communities that we see a lot of action out there as well. We're really proud of what our community says about us. We're now at the end of tonight's class. We got some time kind of carved out before we get to the top of the hour. I haven't got any questions yet, so I'd love to get some questions from our audience. Looks like we had a few of you join a little bit late, but again, we've recorded tonight's class, so we'll get all this material back out to you. But any questions on the minds of those attending tonight that I can help answer for you? And I know depending on what time zone you're in, I could be like in the middle of dinner, could be like if you're on the West Coast, could be just before you're getting off work, or getting prepared for dinner in the Midwest. So it just depends. So I appreciate you guys taking time out of your schedules. But any questions I can help answer? Okay. Hope that means I was really thorough tonight, and I hope you enjoy the content. I do hope I get a chance also to meet with each of you and to help you on that goal towards homeownership, whether that's a goal of this year or next year. Oh, we did get Oh, no questions. Okay. I got a chat alert. I was like, okay, I was excited for a question, but no question. And thank you for the compliment. I appreciate that. But yeah, I do hope I get a chance to meet with all of you at some point in time. I just want to be kind of just a partner to help you guys in this journey. It doesn't have to be a goal for this year in 26. It could be something 2 years out. But I think it's important for you to have all the right tools available to you so you can make a great financial decision. So I hope you guys have a great rest of the week. We'll get all this material back out to you tomorrow and look forward to staying connected with you all soon. Have a good night.